Hello, this is John Piper with the weekend video clip, and it's Saturday the 12th of December, and I thought there was a couple of comments from some other people. RMG Wealth Management is a company I use to manage some of my cash. This is their report this morning. They have done a chart of the MSCI World Equity Index, just showing that there's been zero growth over the last 18 months or so. You also notice that the pattern actually does I've got red arrows too. You have got a possible head and shoulders here with a head there, right shoulder here. So we start coming down here, we'll get a sell signal from this situation there with a lower right shoulder, which denotes some kind of weakness. That's one point. And they basically say that the chart below depicts what we envisage as the best case scenario. The MSCI World Index has been thrashing around with no gain for over 18 months now. During this period, global economic growth has disappointed. Central banks have been encouraging gross speculation with continuous unconventional monetary easing, and fewer asset stocks have actually risen in value. That's another way of saying that the larder is bare, as I was saying in a report earlier this week. Now, another comment from David Fuller. It isn't actually a comment from David Fuller, it's a comment from a summary from Bloomberg. But the point I wanted to make is that they're saying that optimism that the US economy is strong enough to withstand higher rates transformed into anxiousness as a commodity sell-off clouded the prospects of a global recovery and rekindled deflation concerns. The benchmark US equity gauge ended at its lowest level since October, amid concern that a rout in high-yield credit markets will spread at the same time that money managers must cope with shifting monetary policy. As you know, I've been saying consistently that I think interest rates may well not be increased, and if they are, it'll be a PR stunt, and I guess that sort of supports that view. It's all quite important stuff, really. I mean, where we are in the global trend is pretty critical. I remain of the view that we're going to see sharp falls next year, and both these comments sort of from different angles say the same kind of thing, basically. I think it's fair to say. Anyway, let's have a look at the charts and see what they're saying. Well, starting with the Dow, this is again the daily chart. You can see the sharp decline, A, B, C, B. Now this one is looking at a C wave. I prefer this to be a 5-wave form. It's not. This does allow for some kind of rally to take place, but I'm now given the time of year, given them not seeing any upside, we may see a bit of upside next week, perhaps, or into the final sessions of 2015. But I think we're going to see a break, and I think we're going to head down. So it's just a matter of positioning for that move, really. So let's have a look at this in a bit more detail. This is a 2-hourly chart. I mean, you can see that this is a clear A, B, C down to there. This looks far more impulsive. We've got 5 waves to there, but then we've got an ABC at the end of it, which is not exactly clear. Then we've got ABC down, quickly retraced, and now we're going down again. You know, there's really no pattern there at all to talk about. Could even be a triangle of some sort, I suppose, at this point, although that might change quite quickly. We've got the FOMC meeting next week. Maybe things will quieten down ahead of that. There'll be some soothing noises. There will be a tendency, I think, at this time of year for some sort of stability, which is what I've been looking for, really, and saying that's what I expected. We're just not seeing it, unsurprisingly, in the overall circumstances, I think. Right, the daily chart of FTSE, as I've said before, big decline, clear ABC, and fairly weak rally, just going above the 50% level, which is somewhere around here. We've now got I think it must be a 1-2, although the wave count, the actual division in the waves doesn't support that, and now we're accelerating down again. Again, we have expiry next week. We have this news next week. We have the Christmas period. So there are various reasons why we should see stability, but I say there's lots of reasons why we should not, really. It's a question of timing, really, to go down the scale. Okay, then I think you're about to give some support to a bounce next week. Is that we have got a 1, 2, 5 parts, 3, 4, 5. So there's potentially 5 waves down there. So that would perhaps give us some support, but a corrective rally now into the expiry period, or maybe into Christmas, even the New Year, could easily set the scene for some, say, very large falls next year. Right, the DAX is more volatile. A, B, C. I think this is A, irregular B, C. We've actually got quite a clear 5 waves there, up to there. We're now coming down again. So again, I think that the decline has begun at this point. Let's go down a leg. Right, this is the hourly chart. Again, there's some encouragement for the view that we could see some stability. 1, 2, 3 to there, maybe 4. Subnormal 5 perhaps. Could be a 2 wave followed by 1, 2, 3, 4. Definitely a case here for a 5th. So again, we have some support for the view that we could see a rally. Be a 4th wave. Resistance would be 10.6. But there could be some respite, and of course the FOMC meeting next week would be quite a key part. See how that is taken. I mean, the thing is, if you're in a bear market, then all news is generally interpreted negatively in one way or the other, especially with interest rates. I mean, it's obviously a double-edged sword between if one has an excuse to raise interest rates, then okay, that's a positive because it means the economy is doing better. But the actual raising the interest rates is a negative. Similarly, if the economy is doing badly, you can actually take the view, well, interest rates will stay low, therefore that's good news. But all these things have double-edged swords, and it depends on the market phase as to how it will be interpreted. But right now, there seems to be a case that we could see some kind of bounce into, maybe into expiry on Friday. I wouldn't like to look much further ahead than that, really, to be honest. One of the problems with these markets is the very sharp durations we're getting up and down. It's very hard to hold spread betting positions through such things. I mean, for example, we have the news next week with the FOMC. It could easily produce a sharp rally. If we take short positions, easily get stopped out by some kind of wild jerk. ETFs are quite useful. If you want to be short, then buying an ETF, a short ETF of any of the markets, is one way. Another way is trading the VIX. The VIX it's still quite low. It's gone up a bit with the last action in the last few days, but it's still pretty low. I think around the 20 level. It can easily go up to 50 or 60. It went up to 55 in August, in fact. So the VIX is one way, but again, you have the same kind of issue. I mean, I've been holding a VIX position for some time now, and it's you had to roll it over with IG, so that does actually cost a bit of cash. So it's quite. Spread betting is nice and easy, but it doesn't always suit the market conditions, and that's really the case with this situation. I think ETFs is probably best. I'll be looking to probably issue a general sell signal. I did this in 2007, as I recall. General buy signal in 2009. I think I issued one between then and now, but I think we're going to see a situation where we should just be getting out of equities, out of probably assets generally. In fact, I think there's the potential for quite a big problem here. We've still got the issue that we could get a deflation situation. I mean, deflation is really the enemy, I think, to an extent, and everything the governments have been doing have been trying to stave off deflation. But if deflation were to actually get hold, then that would have a different asset class needed. Whereas if we get wild inflation, which is it seems rather unlikely in the situation, the governments have been trying to achieve that and just failed miserably. So I think deflation is probably the most likely outcome. In deflation, then assets tend to go down in value, and cash is king. So in a deflation situation, you want cash, possibly including gold. I mean, gold is a store of cash. Right, I'll go on to gold next. Right, potential positives here. We have a possible 5-wave advance here. Not the ideal pattern again, with a much longer 5th wave, which is not ideal. Possible A, B, C, and some decent buying came in yesterday, which is why you should have buy signal around current levels actually. So you should have got an SMS from yesterday saying I had bought gold. I don't recommend things, I just see what I'm doing, so it's up to you whether you want to do it or not. But anyway, the stop is down below, my stop is down below 1060. You could use acceptance, but it means watching the level. The concept of acceptance is explained in the way to trade. So we're now long of gold. Again, it's not certain because we have a couple of issues here. We're setting it on ABC there, that's clear. And that 5 waves is the only problem is the extended 5th, but that's acceptable. There's nothing wrong with that. So we have a setup. It'll be confirmed when we get above there. So one could buy extra there, and you could also, of course, use extreme stop to add to positions. So one could want to add on a break up there, and with gold it works really well. Actually, it's one of the best markets for using extreme stop. Alright, so the weekly Chinese market, China 300 on IG. I count that as impulsive. Get rid of this thing again. So I count this as impulsive. This is fairly corrective. The pattern here is not ideal. I did go short, as I mentioned, and it's currently in profit, not by a huge amount, but I think there's a case now we're going to see this just fall away. I think look at the time parameters, it's almost exactly correct with about 3 months down to there, 3-4 months, and similarly to here to the peak. No, sorry, about 2 or 3 months. So again, precisely correct actually in terms of Fibonacci relationships. So I think a case there for going short. It's again the same kind of parameters really. You don't know what's going to happen. Currently the high is around 3.5, 3.6. So 200-300 points away from the current level. Minimum size is £5 a point on that market. So you have to consider whether that's an acceptable risk from your own trading parameters. I'll look at Euro Sterling today. This is the final chart. This is the weekly chart. So I have got this 5 waves. I mentioned that before. So the euro is rallying. It then fell back sharply. It looks quite impulsive, but we've now reversed that trend and we're getting up again. So there is now a stronger case that we actually are seeing a change here, and that the euro is going to go ahead. As I mentioned, I do have a small position on this market, more as a hedge against the euro rallying, because as you know, I live in Spain, so I need euros, but I haven't actually traded as such. But it looks like it's going the right way. We'll go down a leg. This is the hourly chart. So you can see pretty impulsive action to there, pretty corrective action to here. So at the moment, it's looking like the trend is certainly up on the euro sterling. Okay, that's all for today. Actually, it's not. I want one final thing. Right, I'll give a further quote from the RMG report. Charles Gave points out, history has thrown out multiple attempts to create wealth by printing money, from the Song dynasty to Renaissance era Italian bankers, through revolutionaries in France and their assignat notes, to more recent cases in Zimbabwe. Mr. Gave goes on to consider in more detail the Mississippi bubble, during which a previously bankrupt France, because of the previous wars during the reign of Louis XIV, witnessed a huge increase in asset prices due to money printing. The Mississippi bubble eventually burst, and investors lost vast fortunes. The point being that printing money simply does not create wealth. Instead, and for a short period of time, 3 years in the case of the Mississippi bubble, there is a wealth illusion as asset prices rise. Ultimately, the illusion will crack, and investors will try and sell their inflated assets. Initially, they may want to sell on a rally, then they'll try and sell at market. However, as it becomes obvious that the bubble has burst, they will sell to anybody at any price, no matter how low the bid is. By this time, investors are way past the moment of wealth preservation, and are now in the realms of trying to salvage any remaining wealth they may have, i.e. the return of capital, not the return on capital. So on that happy note, I think I'll end the report here. I would mention that there's similar material in my book, Financial Cataclysm Now. I mean, things have changed a bit since I published it in 2006, but what's really happened is that the powers that be have extended the situation by QE, etc., so that we actually now got a worse problem really than we had back in 2007, 2006, 2007. At least that's a fair. In fact, that's been happening since I think the 1960s. You know, the governments have been creating more and more ways of prolonging the boom years, as it were. It's gone into intensive care in my parlance. You know, they've just done everything they can to keep it going. But the same problem is still there. We still have to deal with the situation that the asset values are rather illusory in many ways. Anyway, hope you found it interesting and useful. I'll be back with the report on Tuesday morning from the UK, in fact, just for a change. Have a great weekend. Thanks for listening, and bye for now.